Now, in May this year, at the troughs of the COVID-19 related lockdown, S&P Global Ratings agency affirmed South Africa's long-term foreign and local currency debt ratings at BB and BB minus and BB respectively, and maintained a stable outlook. We're now joined by Ravi Bhatia, who is Director of Foreign and International Public Finance Rating at S&P Global. Thank you so much for your time this afternoon, sir. Now, ratings agencies such as S&P Global have sent rather sobering warnings about South Africa's economic growth outlook, and this is particularly with the COVID-19 pandemic still with us. If you could perhaps just paint a picture of where South Africa is economically as we await the midterm budget by Finance Minister Tito Mboweni tomorrow.
Sure. Yeah, I mean, I think, the background to this is that South Africa's for the best part of the last half decade basically has had very low growth and rising fiscal deficits. And then at the back end of last year, there was recessionary pressure. So coming into the COVID crisis, you could say that on a growth and fiscal trajectory, South Africa was already weak. We had put South Africa on negative outlook in November last year, and then we downgraded in April of this year. On the back of that. So basically, a weak situation which was then hit by COVID, which exacerbated things a lot. South Africa also chose to have a very aggressive lockdown, Western style lockdown, which then, had a big impact on the economy and also a big fiscal expenditure package to support the economy. So that had an impact on the fiscus, and now we're seeing debt rising. Net debt close to, if you look at the trajectory, going up to around close to 90% of GDP. So quite a lot of pressures across the board, you could say. And the question is, the supplementary budget and the plan for fiscal consolidation. But we'll see more on that tomorrow.
Now, in February, the Finance Minister, Tito Mboweni, reneged on the wage agreement with government workers in order to bring that wage bill down and also to save billions of rands. Now, if Mboweni then goes on and goes back on this particular decision and decides to honor the agreement, what would that mean for the country's rating?
Well, I mean, it's more like... we're going to look at the broad fiscal trajectory. It doesn't really, it matters less, shall we say, where the savings come from. The question is, is fiscal consolidation or control going to be pushed through? They have this wage deal that they're looking at, and that'll be one of the aspects that we're looking at. I mean, it's more also how much they can save also, or rather how much they will spend on the SOEs and the parastatals. These things combined, and whether there'll be any revenue initiatives as well on the revenue side. So, we'll be watching all of that, but it's really a case of whether we're going to see fiscal control and fiscal consolidation or pressures on expenditure.
I mean, you spoke about debt a little bit earlier on, but how dangerous is South Africa's debt trajectory when Minister Mboweni himself has warned that South Africa faces a fiscal cliff which is similar to that of Argentina? Yeah,
I mean, I think the difference with Argentina, you could say, is that South Africa has a deep domestic debt market, and the bulk of the issuance is in rand. So, and there's a lot of players in the domestic market that can help finance the deficit. But that is kind of now, as these levels rise to around, 80–90% of GDP, the question is whether that old story, we could say, is continuing, and whether there will be enough liquidity in the domestic market to help finance the deficits. I mean, we're seeing interest costs rising to, going up beyond 20% of government revenues. So more pressure and more cost there. Whether the foreigners are going to stay in the market, I mean, they come in and they buy the rand debt. That'll also be an issue of wider EM sentiment. And of course, South Africa got the IMF funding. So it's a combination. But yes, indeed, there's a concern around these high debt levels of, close to 90% of GDP.
So what should South Africa be spending its debt on? I mean, we can acknowledge that there are many competing demands, including the wages, the state-owned enterprises like SAA, there's Denel, there's Land Bank, there's Eskom, all of them needing government money. So how does government allocate?
Well, I think if you look at it, I mean, the bulk of the allocation actually goes to Eskom, and the others are, compared to Eskom, relatively smaller. But the question is also whether there's going to be a change to this SOE structure, or whether there's going to be a turnaround in the SOEs, making them more profitable, and how that is going to pan out, because more competition in those sectors, because the SOEs dominate large parts of the economy and aren't necessarily giving the best return on government money. So it's really a case of allocations that will deliver stronger GDP growth. And the government will look at that. But basically, I think the fundamental problem in South Africa, which has exacerbated the fiscal problem, is that GDP growth has been so low. So once you get an improvement in GDP growth, that would help also the fiscal story.
Just as I let you go, perhaps in just 30 seconds, Mr. Bhatia, as we wrap up, what can the minister do tomorrow to ensure that South Africa doesn't fall deeper into sub-investment grade? What would make S&P not change its outlook on South Africa?
Well, I think if there's a credible fiscal plan that contains the deficits and at the same time potentially some reforms that would help the GDP growth story. So a combination of that, is what not only us but all commentators are looking at.
Well, we thank you so much for your insight and your time this afternoon, Mr. Bhatia. That's Mr. Ravi Bhatia there from S&P Global.